Welcome back to the deep dive. We've got the papers in front of us, the Q3 2025 financials, and the strategic update from a major global power player. And honestly, there's some real tension baked into these results.
No, absolutely. It's a fascinating snapshot, isn't it? You've got this huge company trying to juggle, well, two very different things. On one hand, their traditional market, trucking, is facing a really steep cyclical drop.
Right, the bread and butter.
Exactly.
Hmm.
But on the other hand, they're pushing hard on this destination zero strategy, zero emissions, electrification, hydrogen, which is expensive and, frankly, seems heavily tied to shifting government policies.
And that's our mission today. We want to unpack this, go beyond just the headline figures. We'll look at what parts of the business are surprisingly strong, and you might be surprised why.
Like that AI connection we spotted.
Yeah, exactly. And then we need to look at the flip side, the really significant multi-million-dollar hits they're taking, seemingly because of policy uncertainty impacting that future tech stuff. So let's dig into Q3 2025. Okay, so starting high level. The big number, revenue, was $8.3 billion for the quarter.
Right. Which is down 2% compared to the same time last year, Q3 2024.
Only 2% down, given how tough things are supposed to be in trucking. That almost sounds not too bad. Manageable, maybe?
It does seem surprisingly resilient on the surface. But you really need to look at that alongside the profit number, the net income.
Okay.
So the profit they actually kept was $536 million. That works out to 3.86 cents per share, diluted EPS.
$3.86 EPS. Okay, that's where you see the impact, because wasn't it like over $800 million last year?
It was, yes. $809 million in Q3 2024. So that's a pretty substantial drop in actual profit making it to the bottom line. Big slice out.
Yeah, definitely feeling the pressure there.
Exactly. And it's important to note that $536 million figure includes some pretty big strategic charges, which I know we'll get into later.
Right.
But the overall story, and the CEO Jennifer Rumsey highlighted this, is that the company's diversification, having all these different business lines, really did help them manage through what she called that anticipated sharp decline in the North American truck market. Operationally, they held up quite well, even if the final net profit number looks weaker.
Okay, so that operational strength, that brings us to EBITDA, right? That's a better measure of how the core business is running.
Yeah, earnings before interest, taxes, depreciation, and amortization. It gives you a cleaner look at operational performance. It came in at $1.2 billion.
$1.2 billion, and as a percentage of sales.
That's 14.3% of sales, which is, pretty solid. It reflects decent operational efficiency.
Yeah.
But even that number was pulled down a bit by those specific non-cash charges hitting the zero emissions part of the business.
So the overall picture is complicated. Revenue looks stable, but it's really hiding two very different trends underneath.
Precisely. Different divisions telling very different stories.
Okay, so if the overall result was only slightly down despite the trucking chaos, something must have been doing really well. Where did the profit and stability actually come from this quarter? Which segment was the hero?
No question about it. The power systems segment. Their performance wasn't just good, it was actually kind of stunning.
Okay.
Sales were up 18%, and their operational profit, the segment EBITDA, jumped, get this,
Yeah.
39%.
39%. Wow. In power systems, that's generators, big industrial engines, that kind of thing.
Exactly. Reaching $457 million in EBITDA, which is almost 23% margin on sales. Very profitable.
A nearly 40% jump in profit. That doesn't sound like just a general economic uptick. That feels like something specific is driving demand.
It is incredibly specific, and this was a key nugget we pulled out. The growth was almost entirely fueled by soaring demand for power generation, and specifically to service data center markets.
Data centers. Okay, that makes sense with everything we hear about AI and cloud growth.
Absolutely. And it wasn't just North America. This demand was global. They called out India and China as being particularly strong, too.
So that's a major structural shift playing out right here in these numbers, isn't it? The need for digital infrastructure, for AI, for cloud storage. It's actually generating enough profit to offset weakness in traditional diesel trucks.
It's like the perfect portfolio hedge playing out in real time.
Yeah.
And naturally, that strength then flowed through to the service side, the distribution segment.
Okay, tell us about distribution. How do they do?
Also, very strong, consistent performance. Because, they're the ones servicing all these power systems out in the field. Their sales increased 7%.
Okay.
And their EBITDA was up a very healthy 33%, hitting $492 million. And again, the commentary attributed this mainly to that higher demand for power generation products, especially in North America.
So connecting the dots, these reliable power solutions, keeping the lights on for data centers and the cloud, they're not just a side business anymore.
Not at all.
Yeah.
Right now, they look like the primary engine driving profitability and offsetting that really quite severe softness in the company's historical core business, which is transportation.
Which means we have to pivot now and look directly at those core segments. If power systems was booming like that, then the engine and component segments must have really taken a nosedive for the company overall to only be down 2%.
Oh, they absolutely hit that cyclical trough everyone was expecting. This is where you see that sharp decline in North American trucking really bite down on the numbers. Take the engine segment first.
Okay.
Total sales there decreased 11%. And the segment's EBITDA. It fell dramatically down, 39% to $261 million.
Oof, a 39% drop in profitability. That tells you their factories must have been running much less full, right? What were the specific pain points there?
Yeah, the utilization hit is clear, and the numbers behind it are pretty brutal. In North America for this quarter, heavy-duty truck shipments were down a devastating 36%.
36%.
And it was even worse for medium-duty trucks and buses. Shipments down 50%, half.
50%. Yeah, this wasn't just a gradual slowdown. This was the cliff edge correction the market feared.
Exactly, a very sharp correction.
And I assume since the components segment makes the guts for those trucks, the drivetrains, emission systems, axles, etc., their results must have mirrored that plunge pretty closely.
They did, very closely. Components saw total sales drop 15%, and their segment EBITDA decreased 17%.
Okay, 17% drop in profitability. Still bad, but maybe slightly less dramatic on the profit side than engines.
Slightly. I mean, it was clearly driven by that lower truck building activity in North America, fewer trucks mean fewer components sold.
Yep.
But yeah, we probably need to watch if that 17% drop is purely volume, or if maybe there's some increased pricing pressure creeping in as the market shrinks.
Good point. Competition heats up when the pie gets smaller.
For now, though, it's just a really clear picture of how tightly coupled those traditional engine and component segments still are to the fortunes of the North American truck market.
All right, let's shift gears to the future bet. The big, expensive pivot. Destination Zero, which lives inside their Accelera segment. This is where the hydrogen tech electrolyzers and the electric powertrains sit. How did Accelera look in Q3?
Well, it's another one of those contrasting stories.
Yeah.
On the surface, sales were actually up 10% year over year, hitting $121 million. Mostly driven by higher demand for their e-mobility products, like electric axles.
Okay, 10% sales growth sounds positive for a future tech segment.
It does, but that's completely overshadowed by the bottom line. The segment reported an EBITDA loss of $336 million.
Whoa, hang on. A loss of $336 million in one quarter from the future tech division. That's enormous, especially when you said their total company net income was only $536 million. What on earth caused a loss that big?
This is really a critical piece of the Q3 puzzle, and it's the source of that big hit to net income we flagged earlier. The actual operational loss wasn't that huge, but it was swamped by $240 million in non-cash charges, and these were specifically tied to the electrolyzer part of the business.
Okay, $240 million. Let's pause here. Non-cash charges. What does that actually mean for them, and what were the components?
Right, non-cash means they didn't actually spend $240 million in cash during the quarter for this. It's an accounting adjustment. It basically reflects a sudden, significant drop in the perceived future value of an asset they already owned.
Okay.
The biggest piece, $210 million of it, was something called a goodwill impairment charge. Goodwill isn't physical stuff. It's the extra value, the premium, they booked when they perhaps acquired or heavily invested in that hydrogen technology based on its expected future earnings.
So they're saying $210 million of that expected future value just evaporated. Why? Did the tech fail?
No, and this is the crucial part. The source material is explicit. The write-down was triggered by rapidly deteriorating conditions and significant uncertainty in the alternative power markets. And the direct cause cited: reductions in government incentives and major shifts in policy that lowered the expectations for how quickly hydrogen would be adopted.
Wow. So the government changes its mind on subsidies and poof, $210 million in expected future value gets wiped off the books. That's political risk hitting the balance sheet hard.
It absolutely is. That future promise, the goodwill, effectively vanished when policy support weakened. The other $30 million of the charge was more straightforward, writing down the value of actual electrolyzer inventory they now don't expect to sell, or at least not at the price they thought, excess and obsolete.
The implications are huge. They took this massive financial hit, and now the report says management is launching a formal strategic review of the entire electrolyzer business, basically rethinking the whole thing because the demand prospects look significantly weaker now, thanks to those policy shifts.
Exactly. A major reality check for that part of Destination Zero.
And that Accelera hit, big as it is, it's only one example of this policy volatility, right? Let's look at the broader landscape because it seems like policy swings are adding costs and uncertainty well beyond just the hydrogen market.
They really are. We saw another direct hit from new tax legislation. Remember the One Big Beautiful Bill Act signed back on July 4th, 2025?
Ah, yes. How did that play out this quarter?
Well, its implementation resulted in an immediate $36 million increase to their Q3 tax expense. That single change knocked $0.26 off their diluted EPS for the quarter.
36 million extra in taxes just like that. What part of the law caused that?
According to the report, it was mainly due to two things: a reduction in the deduction allowed for foreign income, and changes to how R&D tax credits work.
So it hits their international earnings and makes it more expensive to invest in future research.
Pretty much.
Yeah.
And the result was their effective tax rate jumped dramatically. It soared to 32.7% in Q3 this year, way up from only 19.2% in Q3 last year.
That's a massive swing driven purely by legislation, nothing to do with their actual sales or operations.
Correct. Pure policy impact.
Okay, what about other external factors, like tariffs and global trade friction? That's usually a headache.
Surprisingly, less so this quarter, it seems. Despite, all the ongoing uncertainty, the company reported that the net financial impact of tariff costs and any related recoveries was actually immaterial for Q3. They appear to be managing that specific pressure effectively for now.
Good news on that front, at least. But you flagged another big one earlier, a potential regulatory risk hanging over them related to emissions credits. This sounds like another potential bombshell.
It is. It's a forward-looking risk, meaning it hasn't hit yet, but it could.
Yeah.
And it's also non-cash, like the goodwill charge. The risk relates to the greenhouse gas emissions credits.
So another $149 million potentially wiped out, purely depending on a regulatory decision in Washington.
Exactly. It's just sitting there as a risk on the balance sheet, waiting for a signature.
Okay. Before we wrap up, amidst all this financial pressure from operations and policy risk, did they show any signs of underlying financial strength, like managing their debt?
They did, actually. They made a point of noting they repaid $500 million of senior notes that were coming due in 2025, and they did it using cash on hand.
So, despite the write-downs and tax hits, the core operations are still generating enough cash to handle significant debt payments. That's something.
It shows there's still fundamental strength there, yes, but it's being tested from multiple angles. Hashtag tag outro.
So let's try to synthesize this. It really is a tale of two companies within one, isn't it? You've got power systems absolutely booming, seemingly riding the wave of data center and AI infrastructure needs, providing real stability.
Absolutely crucial stability right now.
But that strength is masking, well, first, the deep cyclical pain in the traditional trucking markets, the engine and component side. And maybe more critically, it's masking this really expensive and frankly painful strategic adjustment happening in Accelera, an adjustment forced on them not by the market failing, but by unpredictable policy shifts.
That's the core tension. And what does it all mean for the immediate future? Well, management took a pretty significant step. They decided to withhold their full-year guidance for 2025.
They're not giving any forecast for the rest of the year. For a company this size, that's a big deal.
It really is. It's not just being cautious. It signals that the level of uncertainty, particularly around these policy-driven factors in some end markets, is just too high right now.
Yeah.
It's become effectively unquantifiable for them. They can't reliably predict earnings when the rules of the game might change dramatically next quarter.
Political uncertainty translating directly into corporate financial paralysis. That seems to be the big takeaway.
I think so. And maybe that leaves us with a final thought, something for you, the listener, to mull over. When you see this kind of immediate financial pain directly caused by policy whiplash, the $240 million Accelera charge, the $36 million extra tax, that looming $149 million credit risk, how effectively can a company like this keep pouring billions into a long-term strategic pivot like Destination Zero, especially when the regulatory goalposts seem to be constantly moving, threatening to wipe out the value of those investments almost overnight?
Yeah, how do you plan for the long term in that environment?
It's incredibly difficult. So definitely keep an eye on what comes out of that Accelera strategic review, and certainly watch for any final decisions on those emissions credits. That'll tell us a lot about the path forward.